DocuSign is an interesting growth stock with powerful tailwinds pushing revenue higher industry-wide. Electronic signatures are so much more convenient than in-person signatures, and I'm forecasting electronic signatures to continue to gain market share for several years more. Now, I'm not saying electronic signatures will ever become 100% of the industry. There will always be some signatures and some documents that need to be signed in person, but I think the industry overall will lean a lot more towards a lot higher share of electronically signed documents compared to where it is today. And DocuSign has been one stock that I've been recommending as a way to capitalize on that powerful tailwind. But do I still think DocuSign stock is a buy? That's the question I'm going to answer in this video. I'm going to review the latest company's performance numbers and highlight what I think about the company, share with you my fair value calculation, and update my buy or sell rating on DocuSign stock here. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So in their most recently completed quarter, the management team said that revenue came in at 801 million, which was up 9% year over year. Billings were up 13% year over year at 818 million. So billings are similar to what you might see in other companies that report remaining performance obligations. Billings is a similar metric for DocuSign in that it counts the signing of new deals the company delivered in the quarter. That means the signatures that they agreed to will eventually turn into revenue, but they haven't just yet. So a company might agree to a deal with DocuSign for 100 signatures, but that company might take 6 months to go through those 100 signatures that they agreed to in a deal with DocuSign. So as they use up those signatures that they agreed for, that then turns into revenue. So billings is an indication of what DocuSign's revenue will look like in the upcoming quarters and upcoming years. And similar to remaining performance obligations, where I say I like to see RPO that's growing faster than revenue growth, I like to see billings growing faster than revenue growth for DocuSign. And that is what I saw here in the most recent quarter for DocuSign, which was surprising and significantly positive because typically companies that report those kinds of metrics sell at premium valuations, and DocuSign stock has not been selling at a premium valuation. It's been selling at a relatively cheap forward PE and a relatively cheap valuation when measured by my DCF valuation. And so to see these kinds of positive metrics from a company that's trading so cheaply is really attractive for investors. The company said second quarter top line performance accelerated. Remember, acceleration is the second derivative, the rate of increase. They're saying that the second quarter top line performance accelerated and represented one of our strongest growth quarters over the past few years. That's exciting. Again, especially because this is a relatively cheap stock. It's not selling at the valuation of a company like Palantir, right? Which is reporting all of these kinds of numbers, accelerating revenue growth, accelerating RPO. All of those things are working extremely well for Palantir, but it's selling at a price that's like 10 times the valuation of DocuSign. But DocuSign is reporting similarly good numbers here. The company mentioning improved fundamentals across e-signatures and CLM customers and growing contribution from IAM demand. So CLM customers, IAM demand, these are variations of the company's products and services they offer, and new variations of their services are intriguing to customers, and it's nice for investors to see they're able to package their services in a way that's generating an increase in demand. So DocuSign's business model can be extremely lucrative, right? That's been one of the reasons why I've liked DocuSign stock. And of course, the downside of DocuSign stock I haven't talked about yet, but I'll mention it here because I've talked a lot about the positives, and I've talked optimistically about DocuSign stock. But one of the main reasons it's trading at such a cheap valuation is because the industry is not very large. In my book, I devote an entire chapter to the total addressable market opportunity. DocuSign has a very small total addressable market opportunity compared to other industries, right? The advertising industry, for instance, is $1 trillion industry in annual spending. The home improvement industry is $1 trillion industry. The travel industry is a multi-trillion-dollar industry, right? These are massive industries with big opportunity for companies to grow extremely large. Electronic signatures, not one of those industries, less than $100 billion in annual revenue. And even at its maturity, I don't expect it to grow very much over $100 billion. So that's one of the reasons why DocuSign will, I think, always trade at a relatively cheap valuation. But the business is strong and the margins are excellent. Non-GAAP operating margins came in at 30%, and free cash flow margins improved modestly to 27%, which, I mentioned they don't need to reinvest in the business all that much, so they can use that capital to repurchase stock, which is what they did. They repurchased $200 million of stock this quarter. By the way, this document I'm reading from is the company's Q2 2026 earnings call transcript with Wall Street Analyst. I've made this document available for my channel members, and you can join my channel for less than $5 a month. See the link in the description for all the benefits you get as a channel member. So I mentioned the valuation is cheap, and one way I measure valuation is through my own proprietary discounted cash flow model. And for DocuSign, I updated this morning, and the intrinsic value per share came to $128 compared to the current market price of $83.52. So this stock still undervalued, in my opinion, according to my calculations. And I see this as a nice opportunity for investors. This isn't one of those stocks that's going to 10x, right? This isn't one of those stocks where, sometimes I give those videos where I say this stock could 10x over the next 5 years. DocuSign is not one of those. This is not one of those companies that has, very, very high potential. But I think this is one of those stocks that trades at an attractive price that could deliver good returns, above average returns for investors for the foreseeable future, until it closes this gap between the current market price and the intrinsic value. And then from that point forward, I wouldn't be surprised if it continues delivering above average returns, because the e-signature industry will continue to gain market share over the overall industry in signatures overall. Again, never going to be 100% of the industry, but from where it is today to where I think it should be, there's a lot of room for growth, many, many years of growth for this industry, because it's not growing very rapidly. It's taking time to grow to gain a significantly more market share of signatures overall. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.